The most dangerous belief in retirement is that once Social Security approves your benefit, the amount reaching your bank account is fixed, protected, and automatic. It is not. In 2026, a retiree can receive a 2.8% cost of living adjustment and still look at the deposit and wonder why the increase feels smaller than expected. Another retiree can see the monthly payment drop by hundreds of dollars even though Congress did not cut the basic benefit. A third person can work a few extra shifts, sell investments, take a large distribution from a 401k, receive a pension adjustment, or ignore one official letter, and then discover that the system has changed the amount withheld from the check. The frightening part is not that these rules are secret. The frightening part is that they are scattered across Social Security, Medicare, the IRS, the Treasury, employers, banks, and tax records, while the average person sees only one number arriving in one account. Pay close attention to this. Your Social Security payment is not one simple payment. It is the final result of several calculations happening behind the scenes, and one incorrect record, one missed deadline, one misunderstood income limit, or one unchallenged notice can affect the money you depend on every month. This is happening quietly. The Social Security Administration calculates a gross benefit from your work record and claiming age. Medicare may subtract a Part B premium and, for some people, an income-related surcharge. The IRS may tax part of the benefit based on combined income. Social Security may withhold money because you are working before full retirement age, because an overpayment was recorded, or because information in the agency's files does not match what you expected. The Department of the Treasury sends the federal payment electronically. Your bank receives the deposit and applies its own account rules. None of that means the government is watching every cup of coffee you buy. It does mean that separate systems exchange information, compare records, detect inconsistencies, and act according to rules that most retirees were never taught. Most people never realize this because the deposit still appears under a familiar description. They see Social Security and assume the number is the benefit. In reality, it may be the benefit after several deductions and adjustments have already taken place. The alert I want you to understand is not a rumor that Social Security will disappear next week. It is more immediate than that. It is the warning hidden in your own record, your own notice, your own Medicare premium, your own tax return, and your own claiming decision. The 2026 Trustees Report projects serious long-term financing pressure, and that deserves attention. But the mistake affecting a retiree this month is usually much more personal. It may be a missing year of earnings. It may be a Medicare surcharge calculated from income earned 2 years earlier. It may be a reduction caused by work before full retirement age. It may be an overpayment notice that gives only a limited window before collection begins. It may be a survivor benefit that was never claimed because the widow assumed the agency would handle everything automatically. This is not automatic. That sentence will matter again and again because the system frequently requires the person receiving the benefit to report, request, appeal, correct, or claim something before the right amount reaches the bank. I have spent decades studying the way American retirement rules interact with taxes, banking, credit, Medicare, pensions, and household decisions. The same pattern appears repeatedly. A person works for 30 or 40 years, pays payroll taxes without missing a paycheck, saves what can be saved, and assumes the retirement system will recognize every detail correctly. Then a letter arrives with language that sounds final. A premium is deducted. A benefit estimate changes. A spouse dies. A tax return shows one unusually high year. An old employer reported wages under the wrong name or Social Security number. The person feels powerless because the letter came from a federal agency and the calculation looks too technical to question. Here is what almost nobody understands. Many of these outcomes are not judgments about whether you deserve help. They are mechanical results produced from the data in the system. When the data is incomplete, old, or misunderstood, the result can still look official. An official number can be based on information that no longer reflects your life. To see why this matters, imagine a retired couple in Ohio. Their gross Social Security benefits rise with the annual adjustment. They expect an extra amount in January. But the husband's Medicare Part B premium rises, and a prior year Roth conversion pushes their modified adjusted gross income above an income threshold used for Medicare. The couple does not see one clean increase. They see the cost of living adjustment on one side and a larger Medicare deduction on the other. They feel as if the Social Security increase vanished. It did not vanish. Two different rules moved in opposite directions. Now imagine a widow in Arizona who receives her own retirement benefit. Her husband dies with a higher benefit record. She assumes Social Security will automatically compare the two and increase her payment. But because she was receiving on her own record rather than as a spouse, she may need to complete an application for survivor benefits. She waits 8 months before calling. In some survivor cases, payment depends on the application date, not simply the date of death. Nobody is going to tell you about this in the way a trusted neighbor would. The agency may send information, but the system does not sit at the kitchen table and explain what the letter means for groceries, rent, prescriptions, and the next 20 years. Before we reach the strongest part of this alert, you need to understand the machine that creates the monthly number. Social Security retirement benefits begin with your earnings history. The agency generally uses your highest 35 years of indexed earnings. If you have fewer than 35 years, the missing years do not disappear. They can enter the calculation as zeros. Think of it as a row of 35 boxes. The system needs a number in every box. If you worked only 28 covered years, 7 boxes may contain 0. If you worked 35 years, but one employer failed to report a year correctly, that box may be lower than it should be. A 0 does not call you. A missing wage does not knock on your door. It simply sits in the formula and quietly reduces the average used to calculate your benefit. Eligibility and benefit amount are related, but they are not the same thing. In 2026, a worker generally earns 1 Social Security credit for each $1,890 of covered earnings, up to 4 credits for the year. Most people need 40 credits to qualify for retirement benefits. But earning 40 credits does not mean you have earned the maximum benefit, and it does not mean every additional year is irrelevant. 40 credits may open the door. The 35-year earnings formula helps decide how much comes through that door. This is why a person can qualify after about 10 years of work and still receive a modest monthly amount. It is also why another year of good earnings can increase a benefit if it replaces a lower year in the top 35. The payroll tax system adds another layer. In 2026, Social Security payroll tax applies up to the taxable wage base of $184,500, while Medicare tax has no comparable wage ceiling. Employees normally see 6.2% for Social Security and 1.45% for Medicare withheld from covered wages, with employers generally matching those amounts. Higher earners may also face the additional Medicare tax under separate rules. This money flows through the tax system, but your future benefit is not a personal account holding the exact dollars taken from your paycheck. Social Security uses a statutory benefit formula. That distinction matters because many workers believe they can look at a lifetime payroll tax total and calculate a direct personal return. The system does not work like a 401k statement. It is social insurance, and the benefit formula is designed to replace a larger share of earnings for lower-wage workers than for high-wage workers. Then claiming age changes the result. For a person born in 1960 or later, full retirement age is 67. Claiming at 62 can reduce the monthly retirement benefit by about 30% compared with waiting until full retirement age. That reduction is generally permanent. Waiting beyond full retirement age can increase the retirement benefit through delayed retirement credits, generally 8% for each full year of delay until age 70. After 70, there is no additional delayed retirement credit for waiting. Watch how this works. Suppose a worker's benefit at 67 would be $2,000 a month. Claiming at 62 could reduce it to roughly $1,400. Waiting until 70 could increase it to roughly $2,480 before future cost of living adjustments. The difference between $1,400 and $2,480 is $1,080 every month. Over 10 years, without even counting future adjustments, that is $129,600. This does not mean everyone should wait. Health, employment, family needs, longevity, debt, and survivor protection all matter. It means the claiming date is not a small administrative choice. It can shape the income floor for the rest of your life. Now the first major revelation becomes visible. Your monthly benefit is not created on the day you retire and then locked in a vault. It is the output of a living record. Earnings can be added. Missing earnings can be corrected. Additional work can replace a lower year. Medicare deductions can change. Tax withholding can change. Family status can create new eligibility. An overpayment decision can reduce the deposit. A life-changing event can justify a lower Medicare surcharge. A new law can remove an old reduction, as happened when the Social Security Fairness Act ended the windfall elimination provision and government pension offset for affected beneficiaries beginning with benefits payable for January 2024. The payment looks like one number, but behind it are many doors. Some open automatically, some do not. You have to know which is which. Slow down for a moment and bring this out of the government language and into an ordinary home. A retired teacher sits at the dining room table with an unopened envelope because every official notice now feels like a threat. A former factory worker checks the bank account at 6 in the morning and sees less than expected. A veteran who took a part-time job to cover property taxes worries that working has somehow punished him. A widow keeps her husband's papers in a grocery bag because she cannot bear to sort through them, and she assumes the agencies already know what happened. A middle-class couple with a paid-off house discovers that one large retirement withdrawal has increased Medicare costs 2 years later. These are not careless people. They are people who worked, paid, saved, and trusted. What hurts them is not always a dramatic fraud or a terrible investment. Sometimes it is a quiet rule applied to a quiet record while life is already difficult. I have watched people lose sleep over letters they did not understand. The envelope sits on the counter. The words overpayment, income-related adjustment, reconsideration, or earnings limit appear in black print. The person imagines bank accounts frozen, benefits canceled, or years of paperwork. That fear creates delay, and delay is often the most expensive response. The smarter response is not panic. It is to separate the gross benefit from the deductions, identify the rule that caused the change, check the date on the notice, and determine whether the information being used is correct. There is usually a path to ask questions, provide evidence, appeal a decision, request a different recovery rate, or claim a benefit that was overlooked. But the path depends on timing. This is why an ignored Social Security alert can affect the monthly benefit even when the underlying law has not changed. The first cycle begins with the most basic record in the system, your earnings history. Most Americans assume an employer's W-2 reaches the IRS reaches Social Security, and the record becomes perfect. Most of the time, wages are reported correctly. But most of the time is not enough when a missing year can remain in a 35-year formula for the rest of your life. Errors can happen because an employer used the wrong Social Security number, a name change was not matched correctly, wages were reported inaccurately, self-employment income was filed incorrectly, or old records never posted as expected. Social Security advises people to review their earnings record regularly and compare it with W-2s, tax returns, and pay stubs. This is not a decorative statement. It is a financial control. Consider Linda, a 63-year-old hospital billing clerk in Pennsylvania. She worked from age 21, took several years away to care for her mother, and later returned to full-time employment. Her benefit estimate looks lower than she expected, but she assumes the estimate is final. When she opens her earnings history, 1 year from the late 1990s shows 0, even though she remembers working overtime that year. Another year shows only a few $1,000s when she earned much more. Those 2 weak years may be included among the 35 years used in her calculation because she already has several legitimate low or 0 years from caregiving. If she finds old W-2s, tax returns, wage statements, or other proof, she can ask Social Security to correct the record. The correction may or may not change the benefit, depending on whether those years enter the top 35, but ignoring the error guarantees the wrong data remains available to the formula. Here is the simple image I want you to remember. Imagine 35 jars lined up on a shelf. Each jar contains 1 year of earnings after indexing rules are applied. Social Security selects those jars to create the average used in the benefit formula. A missing year is an empty jar. A low reported amount is a half-empty jar. If you later earn more and that new year is higher than one of the jars on the shelf, the system may replace the weaker year and recalculate the benefit. Social Security reviews records for working beneficiaries and, when additional earnings raise the benefit, can recalculate and pay the increase retroactive to January following the year of earnings. But the agency can only calculate from earnings that reach the record. An unreported or mismatched year cannot help you until it is corrected. The common error is waiting until the week before retirement to examine the record. Old employers close. Payroll companies change. Paper documents disappear in moves, divorces, floods, and family cleanouts. Memories become less exact. The strongest evidence may be a W-2, tax return, pay stub, or other wage record. If those documents are gone, Social Security may ask for the employer's name, work location, dates, estimated earnings, and the name and Social Security number used at the time. The process can take time. That is why the correct moment to review the earnings record is not only after a problem, it is every year, especially in the years before claiming. There is another hidden mistake inside this rule. A person may see 40 credits and think, I qualify, so the record is good enough. Qualification is not optimization. 40 credits answer whether you are insured for retirement benefits under the usual rule. They do not answer whether your monthly amount reflects every year correctly. This helps both lower-income retirees and comfortable middle-class retirees. For a lower-income worker, one corrected year may improve a modest benefit that pays for food and utilities. For a middle-class worker, correcting a high-earning year may replace a much lower year and improve a benefit that supports healthcare and housing costs. The record is the foundation. If the foundation is wrong, every later calculation rests on the wrong number. The next cycle is the retirement earnings test, one of the most misunderstood rules in Social Security. People hear that they can work while receiving retirement benefits, which is true. Then they hear that Social Security may withhold benefits if they earn too much before full retirement age, which is also true. They combine those statements and conclude that working causes them to lose Social Security forever. That is not the complete picture. In 2026, if you are under full retirement age for the entire year, the annual earnings limit is $24,180. Social Security generally withholds $1 in benefits for every $2 of wages or net self-employment earnings above that limit. In the year you reach full retirement age, a higher limit applies to earnings before the month you reach that age. For 2026, that higher amount is $65,160, and Social Security generally withholds $1 for every $3 above the limit. Beginning with the month you reach full retirement age, the earnings test no longer reduces benefits, regardless of how much you earn. Social Security also recalculates the benefit at full retirement age to give credit for months in which benefits were withheld because of excess earnings. Watch how this works with a real set of numbers. Daniel is 64 and receives $1,600 a month, or $19,200 for the year. He takes a job and earns $34,480 in 2026. That is $10,000 above the $24,180 limit. Under the basic rule, Social Security would withhold $5,000 in benefits, because the withholding is $1 for every $2 above the limit. Daniel does not necessarily receive a neat $416.67 reduction every month. Social Security may withhold full monthly checks until the required amount is recovered, depending on payment administration. He sees no deposit for several months and believes his benefit has been canceled. In reality, the earnings test is withholding benefits under a formula, and the months withheld can later be recognized in the benefit calculation when he reaches full retirement age. The system counts wages from employment and net earnings from self-employment for the earnings test. It generally does not count pensions, annuities, investment income, interest, veterans' benefits, or other government or military retirement benefits as earnings for this purpose. This distinction changes everything. A retiree may panic because a certificate of deposit paid interest or a 401k distribution was large, but those amounts do not operate like wages under the retirement earnings test. They may matter for income taxes or Medicare premiums, which we will reach shortly, but not every dollar of income affects every rule. The mechanism is divided into separate lanes. Wages may affect the earnings test. Combined income may affect taxation of benefits. Modified adjusted gross income may affect Medicare surcharges. Treating all income as one category leads to expensive confusion. There is also a special monthly rule that can help in the first year of retirement. A person may have high annual earnings because of work completed before retiring, but still be considered retired for particular months after stopping or sharply reducing work. In 2026, the monthly amount under the special rule is generally $2,040 for someone under full retirement age all year and $5,430 for someone reaching full retirement age that year, subject to the rule's requirements, including limits on substantial services in self-employment. This is not automatic in the sense that a retiree should assume the agency understands exactly when work stopped, bonuses were paid, or self-employment services ended. Reporting accurate dates and amounts matters. Think about a nurse named Patricia, who retires in April after earning $42,000 from January through March. She starts Social Security in May and earns nothing for the rest of the year. If she looks only at the annual $24,180 limit, she may assume she cannot receive benefits for the year. The special monthly rule may allow full benefits for months she is considered retired, even though annual earnings exceeded the limit. Now think about a self-employed contractor who says he retired but continues negotiating contracts, supervising workers, and performing substantial services. The analysis may be different. The system does not respond to the word retired on a business card. It responds to earnings, services, dates, and program rules. The error almost everyone makes is focusing only on the money withheld and ignoring the reporting obligation. If earnings will be higher than estimated, Social Security needs updated information. If earnings will be lower, the agency may also need that information so benefits are not withheld unnecessarily. An estimate made in January may be wrong by October. A bonus, commission, severance payment, or extra work can change the year. The safest approach is to keep pay records, track gross wages, distinguish wages from other income, and read every notice explaining how the withholding was calculated. If this information is helping you protect your retirement income, leave a like. That simple action tells the platform that clear, serious financial information for older Americans deserves to reach more people. Now notice what these first two cycles reveal. A person can lose money because earnings are missing, and another person can temporarily lose access to benefits because earnings are higher than reported. One problem comes from too little income in the record. The other comes from more current income than the system expected. Both are data problems before they become payment problems. The agency is not sitting in a room deciding whether Daniel or Linda is a good person. A calculation is reading a record. That is why documentation is power. A W-2, tax return, pay stub, retirement date, or employer letter can be more useful than 10 emotional phone calls without dates and numbers. Calm evidence changes records. Panic rarely does. The third cycle is where many retirees discover that the benefit increase announced in the news is not the same as the increase in the bank account. Social Security's 2026 cost of living adjustment is 2.8%. That adjustment increases the gross benefit. But Medicare Part B is commonly deducted from Social Security, and the standard Part B premium in 2026 is $202.90 a month. Some people pay more because of late enrollment penalties. Others pay more because of the income-related monthly adjustment amount, commonly called IRMAA. If the gross benefit rises by $55 but the Medicare deduction rises or an IRMAA surcharge begins, the net deposit may rise by less than $55, stay nearly flat, or even decline. This is not a Social Security cut disguised as Medicare. It is two federal calculations meeting inside one payment. The cost of living adjustment changes the gross Social Security amount. Medicare determines the premium. Social Security often deducts that premium before Treasury sends the deposit. The retiree sees only the net result. Most people never realize this because the Medicare charge is not always experienced as a separate bill. It is embedded inside the Social Security payment. IRMAA creates an even more surprising delay. For 2026, Social Security generally uses the most recent federal tax return available from the IRS, usually the return filed in 2025 for tax year 2024. That means a financial event from 2 years earlier can affect the Medicare amount taken from a current Social Security benefit. For 2026, the standard Part B premium generally applies when modified adjusted gross income is no more than $109,000 for an individual filer or $218,000 for a married couple filing jointly. Above those amounts, income-related surcharges apply in tiers. The first tier adds $81.20 a month to Part B, plus a separate Part D income-related amount if the person has prescription drug coverage. Higher tiers can add hundreds of dollars every month. Imagine Robert and Susan, both retired, living comfortably but carefully. In 2024, they converted $160,000 from a traditional IRA to a Roth IRA because they wanted to reduce future required distributions and leave tax-free assets to their children. The conversion may have been a reasonable long-term strategy, but it increased their modified adjusted gross income for that year. In 2026, they receive a notice showing higher Medicare premiums. They feel blindsided because their current income is much lower. The system is not looking at the money entering their checking account this month. It is using an older tax return supplied by the IRS. That is the 2-year look back at work. Here is where the phrase, This is not automatic becomes financially important. If Robert retired, Susan stopped working, one spouse died, the couple divorced, a pension stopped, or another recognized life-changing event reduced household income, they may be able to request a new IRMA determination using Form SSA 44 and evidence of the event and lower income. Social Security identifies events such as marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income-producing property due to circumstances beyond the person's control, certain pension changes, and certain employer settlements. The surcharge may be correct based on the old return and still be inappropriate for the person's current circumstances under the life-changing event rules. Nobody is going to tell you about this at the exact moment you need it unless you recognize the notice and act. Suppose an individual's Part B premium increases from the standard $202.90 to $284.10 because of the first IRMA tier. That is an additional $81.20 per month, or $974.40 for the year, before any Part D adjustment. For a married couple where both spouses are on Medicare and both are affected, the combined Part B increase can approach $1,948.80 for the year at that tier. At higher tiers, the annual effect becomes much larger. A retiree may spend weeks searching for cheaper groceries while allowing a correctable Medicare surcharge to remain untouched. This is why understanding the notice can be worth more than squeezing another 0.5% from a savings account. The common mistake is assuming that a one-time financial event has only a one-time tax cost. A large traditional IRA withdrawal, a Roth conversion, the sale of appreciated investments, a business sale, or a major capital gain can create several effects. It may increase federal income tax in the year of the event. It may make more Social Security benefits taxable. It may increase Medicare premiums 2 years later. It may change the taxation of investment income. It may affect state taxes depending on where the person lives. One transaction can pass through multiple systems on different calendars. The bank sees the money move now. The IRS sees it on the tax return. Medicare may react later. Social Security then deducts the Medicare amount from the monthly benefit. This is the invisible timeline most people never map. This distinction matters because fear grows when people imagine one giant machine making secret decisions. The truth is less dramatic but more actionable. There are several machines. Each one reads different data. Each one has different deadlines. Each one has different appeal or correction procedures. Your task is not to defeat an invisible government. Your task is to identify which machine produced the number you are seeing. Was it Social Security's earnings formula? The retirement earnings test? Medicare's premium determination? IRS taxation? An overpayment recovery? A bank account change? Once the source is identified, the next step becomes clearer. The fourth cycle is federal taxation of Social Security benefits, and this is where a phrase used in political advertising can mislead people into believing that every retiree's Social Security is tax-free. Under current federal rules, benefits may be taxable when combined income crosses certain thresholds. Combined income generally includes 1/2 of Social Security benefits plus other income, including tax-exempt interest. The base amount is $25,000 for a single filer, head of household, or qualifying surviving spouse, and $32,000 for married couples filing jointly. For married filing separately, the result can be especially harsh if the spouses live together during the year, because the base amount can be zero. Depending on income, up to 85% of Social Security benefits may be included in taxable income. That does not mean there is an 85% tax rate on the benefit. It means up to 85% of the benefit can become part of taxable income and then be taxed at the person's applicable tax rates. That difference is essential. If Mary receives $24,000 in Social Security benefits and the calculation makes $12,000 taxable, she does not send $12,000 to the IRS. The $12,000 is included with other taxable income. The actual tax depends on deductions, filing status, tax brackets, credits, and the rest of the return. Yet, the inclusion formula creates what many planners call a tax torpedo. As other income rises, not only can that additional income be taxed, but a larger portion of Social Security may become taxable. The effective tax impact of one extra dollar can therefore be greater than the visible tax bracket suggests. Picture a retired couple receiving $44,000 in combined Social Security benefits. Half of that is $22,000. Add $28,000 from a pension and $12,000 from an IRA distribution, and their preliminary combined income reaches $62,000 before considering tax-exempt interest or other adjustments. They crossed the $32,000 base amount long ago. A larger share of their Social Security may be taxable. Now suppose they take an extra $20,000 from the IRA to replace a roof. The roof costs $20,000, but the tax consequences may extend beyond the distribution itself because more Social Security can become taxable. If that withdrawal also pushes modified adjusted gross income above an IRMA threshold, Medicare costs may rise in a later year. Think about the impact of this. The roof is paid once. The tax and premium consequences can appear on different schedules. Social Security allows voluntary federal tax withholding from monthly benefits at fixed percentages of 7, 10, 12, or 22%. This can help retirees who otherwise face a large tax bill or estimated tax obligations. But withholding is not automatically optimized for the household. A person can choose too little and owe tax, or choose too much and unnecessarily reduce monthly cash flow. The right amount depends on pensions, wages, IRA distributions, investment income, filing status, and deductions. A retiree who begins consulting work in June may need to revisit withholding. A widow moving from joint filing to single filing may face a different tax picture. A couple making a Roth conversion may need a separate tax payment strategy. The deposit is not the plan. The tax return is not the plan. The household cash flow system must connect the two. For tax years 2025 through 2028, eligible taxpayers age 65 or older may claim an additional senior deduction of up to $6,000 per eligible person or up to $12,000 for a married couple filing jointly when both spouses qualify. The deduction begins to phase out when modified adjusted gross income exceeds $75,000 for an individual or $150,000 for joint filers. This deduction can reduce taxable income, but it does not rewrite the Social Security combined income thresholds, and it does not mean every senior owes no tax on benefits. Most people think they do not qualify for helpful provisions because they hear only broad political slogans. Others assume they qualify automatically and fail to claim a deduction on the return. You have to claim it correctly. This helps both lower-income retirees and comfortable middle-class retirees, but the value depends on income, filing status, and the rest of the tax return. Consider James, age 68, who receives $2,300 a month in Social Security and $100 a month from a pension. He also withdraws $18,000 from a traditional IRA during the year. He hears that seniors received a new deduction and assumes his Social Security cannot be taxed. He stops federal withholding. The next spring, he discovers that part of the benefit is taxable, and the deduction did not erase the entire liability. The mistake was not taking the deduction. The mistake was treating a deduction as a guarantee. Deductions reduce taxable income. They do not automatically cancel every tax calculation upstream. Now tell me in the comments, did you already know this rule, or are you hearing about it for the first time? You can answer with your state, your experience, or simply write "first time." The purpose is not to expose private financial details. It is to show how many ordinary Americans were never given a clear explanation of rules that directly affect retirement income. The deeper lesson is that retirement income is not measured only by the gross amount received. What matters is spendable income after Medicare, federal and state taxes, debt payments, insurance, housing, and required withdrawals. Two retirees can both receive $2,500 in Social Security and live with very different net results. One has no debt, modest other income, and standard Medicare premiums. The other has a mortgage, taxable pension income, IRMA surcharges, and high prescription costs. The same gross Social Security benefit does not create the same retirement security. This is why a monthly alert should be read as part of the entire financial picture, not as an isolated number. The fifth cycle is the overpayment notice, and this is where a normal administrative error can suddenly feel like a financial emergency. An overpayment means Social Security believes you received more than you were entitled to receive. The cause can be unreported work, a late earnings update, a change in marital or family status, a disability-related reporting issue, a pension record, duplicate information, or an agency calculation that was later revised. The notice should explain the amount, the reason, the repayment request, and your rights. What makes this dangerous is the tendency to treat the notice as either unquestionably correct or obviously fraudulent. Both reactions can cause harm. If the notice is genuine, ignoring it does not make the debt disappear. Under the current Social Security guidance, the agency waits at least 30 days after sending an overpayment notice before beginning collection. If no action is taken, Social Security can automatically withhold 50% of a Social Security benefit each month, while the usual SSI recovery rate is different. If a person appeals or requests a waiver within the relevant period, collection may be paused while the request is decided. A person who cannot afford the proposed recovery may request a lower withholding rate, including through Form SSA 634. These are not minor details. On a $2,000 monthly retirement benefit, a 50% withholding means $1,000 may be unavailable for rent, food, utilities, insurance, and prescriptions. Imagine Evelyn, a 71-year-old widow in Georgia. She receives a notice claiming a $9,600 overpayment tied to earnings information from several years earlier. She is certain she did nothing wrong, so she places the letter in a drawer. 30 days pass. When the next payment arrives, half is missing. Evelyn calls the bank, believing the bank has frozen the money. The bank can only confirm the federal deposit amount. The deduction happened before the deposit reached the account. She then calls Social Security in panic, but now she is trying to understand the debt, gather evidence, request reconsideration, and protect monthly cash flow at the same time. A calmer response would begin with verification. Use contact information from the official Social Security website or a known official number, not a number supplied in a suspicious text or email. Confirm that the notice is real. Read the reason and the dates. Compare the claim with pay records, tax returns, prior notices, and benefit statements. If the amount or reason is wrong, ask about appeal rights. If the overpayment occurred but recovery would be unfair under the waiver rules, ask whether a waiver is available. If the debt is valid but the withholding would prevent payment of necessary living expenses, ask about a reduced recovery rate. Different remedies answer different problems. An appeal says the decision is wrong. A waiver generally says recovery should not be required under the applicable standards. A lower rate says the debt may be collected, but the current withholding is unaffordable. This is where scams exploit legitimate fear. Criminals know that Social Security can send real notices and recover real overpayments. They imitate official language, claim a Social Security number is suspended, threaten arrest, demand immediate payment, or instruct people to send gift cards, cash, cryptocurrency, gold, or wire transfers. Social Security does not suspend a Social Security number, demand gift cards, or threaten immediate arrest for refusing to pay on a phone call. A real debt comes with written notice, payment options, and appeal rights. The pressure tactic is the clue. Government administration can be slow, formal, and frustrating. A criminal wants speed, secrecy, and irreversible payment. The sixth cycle involves benefits connected to a spouse, former spouse, or deceased worker. This is where the sentence, "you have to claim it," can be worth years of income. Social Security family rules are complicated because the agency may pay a worker's own retirement benefit first, then add an amount from a spouse's record when the spouse's benefit is higher. A spouse at full retirement age may receive up to 50% of the worker's full retirement benefit, subject to the rules, while claiming earlier can reduce the amount. A divorced spouse may qualify on an ex-spouse's record when the marriage lasted at least 10 years, the claimant is at least 62 and unmarried, and other requirements are met. The divorced spouse benefit does not reduce what the worker or current spouse receives. Survivor benefits operate differently from retirement and spousal benefits. A surviving spouse at survivor full retirement age may generally receive up to 100% of the deceased worker's basic benefit amount, while starting earlier can reduce the percentage. A surviving spouse may have choices about when to claim a survivor benefit and when to claim a retirement benefit on the survivor's own record. Deemed filing rules that link retirement and spousal claims do not apply in the same way to survivor benefits. That distinction can create planning opportunities, but it can also create mistakes when people assume all benefits begin together. Consider Carol, age 62, whose husband died after earning a much higher Social Security benefit. Carol has her own smaller work record. Depending on her circumstances, she may be able to begin one type of benefit and switch to another later. The correct sequence depends on benefit amounts, age, earnings, health, and household needs. There is no universal answer. The error is assuming the system will automatically choose the best lifetime strategy. Social Security representatives can explain program options, but the agency does not act as a personal financial planner comparing every possible investment, tax, and longevity outcome. Another widow, Denise, is already receiving retirement benefits on her own work record when her husband dies. Because she is not receiving a spouse benefit on his record, she should not assume the payment will automatically change to the higher survivor amount. Social Security's guidance says a person in that situation should contact the agency so it can determine whether survivor benefits would pay more, and an application may be required. Survivors should apply promptly because some claims are paid based on the application date rather than automatically back to the date of death. The one-time $255 lump sum death payment also has eligibility rules and generally must be claimed within 2 years. The amount is small, but the principal is large. Eligibility does not always create payment without action. The Social Security Fairness Act created another major correction for certain public workers. Signed into law on January 5, 2025, it ended the windfall elimination provision and government pension offset, which had reduced or eliminated Social Security benefits for some people receiving pensions from work not covered by Social Security. The change applies to benefits payable beginning in January 2024. Teachers, firefighters, police officers, federal employees under the Civil Service Retirement System, and people with certain foreign pensions were among those who could be affected. But not every public employee qualified for an increase. Most state and local public workers were already in Social Security covered employment and were not affected by WEP or GPO. By 2026, Social Security reported sending more than 3.1 million payments totaling about $17 billion under the law. That is a historic adjustment, but here is what almost nobody understands. A large retroactive payment can create secondary questions. It can affect the tax return for the year received. The IRS allows a special lump sum election calculation, in some cases involving benefits paid for earlier years, which may reduce the taxable amount compared with treating everything under the current year calculation. A beneficiary should not assume the entire deposit is tax-free, and should not assume that amending all prior returns is the correct response. The tax rules for a lump sum Social Security payment are specialized. The retroactive deposit can also cause confusion at the bank. A person who normally receives $1,900 suddenly sees $12,000 or $25,000 arrive. The bank's fraud and anti-money laundering systems may flag unusual patterns for internal review, especially if the money is immediately wired, withdrawn in cash, or sent to a new account. That does not mean the bank can simply confiscate a legitimate federal payment. It means banks are required to maintain systems that identify unusual activity. A Social Security payment and a bank compliance review are separate mechanisms meeting in one account. Keep the official benefit notice, confirm the deposit source, and be careful when moving a large retroactive payment under pressure from anyone claiming to protect it. If you want to continue receiving information like this, consider subscribing to the channel and turning on notifications so you do not miss the next explanation. Retirement rules change at different times, and the expensive mistake is often learning about a deadline after it has already passed. The 7th cycle is the payment channel itself. Federal benefits have been moving toward electronic payment for years, and Social Security announced in June 2026 that it plans to complete the transition away from paper checks for beneficiaries this year. Federal requirements effective. September 30th, 2025 call for federal benefits to be paid electronically, with limited waiver procedures for people facing qualifying hardships. A person who still depends on a paper check should not treat this as a minor technology preference. A delayed transition can affect how safely and reliably the monthly benefit arrives. Electronic payment can mean direct deposit to a bank or credit union account, or payment through the Direct Express program for people without a traditional bank account. Paper checks are more vulnerable to loss, theft, alteration, and delivery problems. But electronic payment creates a different responsibility, protecting online credentials and direct deposit information. Social Security has strengthened procedures for changing bank information. A change may require two-factor authentication through a personal My Social Security account or an in-person identity verification process. That can feel inconvenient, but direct deposit fraud is extremely damaging because a criminal does not need to change the benefit calculation. The criminal only needs to redirect the destination. Picture a retiree named Howard who receives $2,150 on the second Wednesday of every month. A criminal obtains enough personal information to attempt an account takeover. Howard has no personal My Social Security account because he believes opening one is risky. In reality, Leaving the account unclaimed can allow an identity thief to try to create credentials first. Creating and securing the account can help the real beneficiary monitor information. Social Security states that an account holder can receive an alert if someone attempts to change an address or direct deposit without permission. That alert is exactly the kind of Social Security alert that should never be ignored. The common mistake is clicking the link inside the alert instead of independently opening the official website. A real-looking email can lead to a fake login page. The safer habit is to close the message, type the official Social Security address yourself, or use a trusted bookmark, and inspect the account from there. Use a strong, unique password and multi-factor authentication. Do not give a caller a one-time security code. The code proves access. Anyone asking you to read it aloud may be trying to enter the account as you. Now we reach the most important revelation in this entire warning. The greatest risk is not one isolated rule. It is the way several correct rules can combine and create a monthly result that looks wrong. While each agency sees only its own piece, Social Security sees an earnings record, a claiming date, a family record, and payment adjustments. Medicare sees enrollment, premiums, and income information from an older tax return. The IRS sees taxable income, Social Security benefits, retirement distributions, capital gains, and deductions. Treasury sends the payment. The bank receives the payment and monitors the account under banking regulations. Credit bureaus track debts and payment history, but they do not calculate the benefit. The Federal Reserve influences rates and financial conditions, but it does not decide your Social Security amount. No single screen in your kitchen shows the entire machine. You have to assemble the picture, visualize the process. An employer sends wage information. A tax return moves through IRS systems. Social Security updates an earnings record. Automated data matching checks records, while banks and Treasury use analytics, including artificial intelligence and some fraud detection work, to identify unusual patterns. A calculation averages the highest 35 years and applies the benefit formula. Claiming age, family status, Medicare premiums, tax withholding, the earnings test, or an overpayment may change the result. Treasury schedules the payment, and the bank posts it. You see one line on a statement. Behind it was a chain of calculations. The silent trap is assuming that because the final deposit arrived on time, every link in that chain must be correct. A payment can arrive perfectly on schedule and still be based on a missing earnings year. It can arrive with a legally correct Medicare surcharge based on income that no longer reflects your life. It can arrive after an avoidable tax withholding choice. It can arrive at half the expected amount because an overpayment notice was ignored. It can arrive in the wrong account because direct deposit credentials were compromised. It can arrive without a survivor increase because no application was completed. A timely deposit proves only that the payment system worked. It does not prove that the amount is the best or correct amount available under every rule. This is why the most valuable document may not be the bank statement. It may be the Social Security statement, the annual cost of living notice, the Medicare IRM-AA notice, the SSA 1099, the overpayment letter, or the earnings history inside a personal My Social Security account. These documents are alerts from different parts of the machine. Read them together. Compare the gross benefit with the net deposit. Identify every deduction. Compare the earnings record with old W-2s and tax returns. Confirm the claiming date and full retirement age. Ask whether work income is being estimated correctly. Look at the tax year Medicare used. Determine whether a life-changing event makes an IRMA-A request appropriate. Verify that beneficiary and family information is current. Keep proof of every report, upload, call, and mailed document. Do not misunderstand me. I am not saying every lower payment is an error. Many reductions are legally correct. Claiming early can permanently reduce the benefit. Medicare premiums are real. Taxes may be owed. Earnings above the limit before full retirement age can cause withholding. Valid overpayments must usually be recovered. The protective mindset is not to reject every decision. It is to refuse to remain confused. You have the right to understand which rule produced the number, what information was used, whether that information is accurate, and what action or appeal is available. This is educational information, not personalized financial, legal, tax, or accounting advice. An inheritance is not automatically a monthly benefit problem, but inherited retirement account distributions can raise taxable income, and federal estate tax applies to qualifying large estates, while some states use separate estate or inheritance taxes. Social Security claiming, Medicare, Roth conversions, pensions, business sales, and large withdrawals can affect several years and several systems. A qualified professional may be worth the cost. But no professional can correct a wage you never mention, appeal a notice you never open, or claim a survivor benefit no one knows about. Your participation is not optional. This is not automatic. The people who protect themselves best are not always the wealthiest or the most educated. They are the people who build a simple habit of verification. They know the gross monthly benefit. They know what Medicare takes. They know whether federal tax is being withheld. They know their full retirement age. They know whether current work can trigger the earnings test. They review the earnings record. They keep official letters. They verify changes through official channels. They do not send money because a caller creates fear. They do not assume a one-time IRA withdrawal ends with a one-time tax bill. They do not assume a spouse's death automatically produces the highest possible payment. They ask calm, specific questions and keep the answers. If you are retired or approaching retirement, the purpose of this alert is not to make you afraid of every envelope or every bank deposit. It is to give you back control. You worked too long to let confusion make decisions for you. You paid into systems that operate through rules, dates, formulas, and records. Those rules can be complicated, but they are not beyond your understanding when someone translates them into ordinary life. A missing earnings year is an empty jar in a 35-year row. An IRMA surcharge is an older tax return reaching forward 2 years. The earnings test is a temporary withholding rule before full retirement age, not a universal tax on all retirement income. Taxation of benefits is a combined income formula, not an 85% tax rate. An overpayment notice is a deadline with rights, not a command to panic. A survivor benefit is protection that may require an application. A direct deposit alert is a warning about the destination of your money, not merely an email to delete. Most people think they do not qualify for corrections, reductions, family benefits, tax deductions, or relief because they have a pension, a paid-off home, or income above the poverty line. That assumption is dangerous. Some programs are designed for people with limited income. Others apply to middle-class retirees facing a specific rule. An IRMA reconsideration can help someone whose income fell after retirement. An earnings record correction can help any covered worker with missing wages. Survivor benefits can matter to a widow who owns a home and has savings. The senior deduction can help eligible people who claim the standard deduction or itemize, subject to income limits. This helps both lower-income retirees and comfortable middle-class retirees. The system does not always divide people into poor enough for help and too comfortable to ask questions. Many rules depend on a particular event, record, age, income measure, or filing status. There is still time to act intelligently. Open the notice, secure the online account, review the earnings history, separate gross benefit from net deposit, verify Medicare premiums, check the tax year used for IRMA, report work accurately, ask about survivor eligibility, respond to overpayment notices before collection begins. Keep your records. None of these steps promises a larger check, and anyone who guarantees an increase without reviewing the facts should not be trusted. But these steps reduce the chance that a preventable error, missed claim, old income figure, or stolen credential controls your retirement income. You are not powerless because the system is complicated. Complexity rewards the person who slows down, verifies the record, and acts before the deadline. The worker who spent 40 years building a life deserves more than a vague deposit and an unexplained deduction. You deserve to know what changed, why it changed, and whether the change is correct. That knowledge will not remove inflation, taxes, healthcare costs, or every risk. It will prevent silence from making the decision for you. Share this video with a spouse, parent, veteran, teacher, former public employee, widow, or friend who depends on Social Security. One clear explanation may help someone open a letter in time, correct an earnings record, stop a fraudulent direct deposit change, or claim a benefit they did not know required action. And if you think this is important, watch the next video appearing on the screen now. In it, I explain another quiet retirement rule that can affect the money of millions of Americans while most people are looking in the wrong place.